Have you been in a situation similar to this one where you see a market that was in an uptrend and then the last low breaks down, and so you logically think the uptrend should be done now, and it no longer makes sense to look for buy setups? But what you would have forgotten is to look on the left of the market if there is a demand that is still unfilled, because the market might have just pushed down not to reverse the trend into a downtrend, but it pushed down so it can fill a demand that you probably forgot about. Here on the left, the market starts from a high and pushes into a low. From that recent low, the market starts gaining bullish pressure, going up and breaking above the last high. If the price breaks above the last high, that means that we just got a higher high swing point. The higher high is a swing point that's representative of a market that's following an uptrend. But for an uptrend to be valid, we need a higher high, which we already have. That should be coupled with a higher low. The higher low is a downside movement that ends above the last low. And see, that's what also happened. Because from this higher high, we got a push to the downside, and this ended above the last low, so it has formed a higher low swing point. From this higher low, the price pushed to the upside, but we see that it was not able to break above the last high, ending below the last high. So it has formed a lower high. A lower high is a swing point of a downtrend, so it gets harder to know what is this trend because we have bullish swing points, being the higher high and higher low. But we also started having a bearish swing point, being a lower high. And from this lower high, we got an aggressive downside movement which broke below the previous higher low. If a higher low breaks down, then that new low becomes a lower low. So now we have two bearish swing points coupled together. We have a lower high that was then followed with a lower low. The moment the market creates the first lower low, that signals a trend change, a market structure shift into a downtrend. On a downtrend, what comes after a lower low is usually a lower high. A lower high is a pullback to the upside that is not able to break the last high, exactly like it did on the last high, which was a lower high as well. So if we expect the next high to not be able to break above the last high, that means that it should end below the last high. The level the pullback ends is often on a supply that's taken from the previous lower high. And so if we expect the pullback to end somewhere around this level, then it makes sense to plan a sell setup from the supply, with the stop loss above the supply, also above the last high, since the expectations for a downtrend continuation would be for another lower high formation, similar to what it did on the last highs, which also constantly ended lower and lower. And the take profit below the last low, again with a similar way of thinking, basically expecting a lower low, just like it did on the last lows, which also ended constantly lower. But as we can see, the market is pushed to the upside very aggressively, this obviously closing this sell setup straight into a stop loss. Why did this happen? Shouldn't the market form lower highs on downtrends? Why did it push so aggressively to the upside? Well, let's take a look at the price action again. Now this downside movement that went from a low into a high, this push to the downside is actually a downtrend from the low time frame. So inside of the internal price action, we would see this as a price action that forms lower highs and lower lows itself. Now we see that this downtrend pattern eventually ended because we got this really aggressive push to the upside. Now this push broke above the internal high from the lower time frame, but also above the external high from this time frame. So this upside push itself created a trend shift from a downtrend into an uptrend. And when the market leaves the downtrend and enters into an uptrend, demand zones start to validate. A demand is found on the last low before the market started to impulse to the upside, which on this price action would be somewhere around this level. We see that this demand didn't got filled quick, and the price basically continued and left the demand behind. But a demand that's left behind does not mean that is invalid. The demand would invalidate the moment the market breaks it down, and that's something that we see that didn't happen. So what actually happened is that the market left this demand, and this bearish action that pushed the price down was really just a pullback for the market to fill the demand. While most would have been trapped because of this downside break, thinking the uptrend has ended because we have a lower low, when that lower low was really just a downside pullback on an uptrend. So the key lesson is to be aware of demand zones to be broken down or already filled before you look for sell setups. Here, a buy setup would have been picture perfect. Now let's see on another market, having a similar price action, especially in the beginning where it starts pushing down from a high into a low on the swing levels. But this straight downside movement is made from multiple lower highs and lower lows on the internal level. The moment the market pushes to the upside, that breaks the external high, but it also breaks above the internal high. So the market went from a downtrend into an uptrend, especially seen on the internal price action. And so when the high breaks, it needs to leave a demand that caused this upside pressure. The demand is found right before that aggressive push to the upside. Now it's where most make the mistake of ignoring this demand. Because if we look at the continuation of the price action, from the local high we had a downside pullback that was then followed with another push to the upside that broke above the last high. So we have a higher low that was then followed with a higher high. And so if we apply the same logic, we would consider a demand zone from the last low. And so if this pullback did not fill the first demand, they forget about this demand because the market has formed another one, and it's from the new demand where most buy setups are being placed. And what you are going to see that will happen a lot of times is that the market breaks down the first demand, and those that forgot about the demand from below, they will consider this downside movement as a break below the last low into a lower low. They are thinking the market is reversing its trend from an uptrend into a downtrend since it basically created a lower low formation. And so if they see a reversal into a downtrend, they will probably look for supply zones near the highs in order to sell this market down into another lower low. The problem is that they completely forgot about the demand from below. And so there are two types of setups that can be taken. One is a buy from the first demand, and on this setup you buy in an expectation of a higher high, which is exactly where you place your take profit. But there's also a bearish bias for those that have considered this break as a trend change into a downtrend. And so they will be looking to sell from a supply in an expectation of a lower low. And let's see what the market does. But also keep in mind that the buy position is basically already opened. It has opened right here, when the price fell down, broke the first demand, and then filled the first demand from below. So from a high, we're having some bearish pressure seen as a downside pullback. But eventually, bullish action came back in, pushing to the upside and breaking above the last highs. This closes the buy setup on a win and closes the sell as a loss setup. Now, as a quick recap, when we're having a market that's following an uptrend, since we see the swing points of higher highs and higher lows, on uptrends it's demand zones that validate. Demand zones are found on swing lows. And if we see that the market has basically continued and left a demand behind, that does not mean that this demand is now invalid even if the market would drop down and break below the last low. The important part is that if the demand did not break, then that demand can still validate later on. For this demand to become invalid, the market would need to create and continue a downtrend pattern of an upside pullback that ends on a lower high, that is later followed with a push to the downside that breaks the last low, and more importantly, it breaks below the demand. It's only now when we can be more confident in a possible upcoming downtrend, so it's only at that point when it makes sense to stop looking for demand zones. But now instead, we will be looking for supply zones on the last highs. And of course, we would be selling down from supplies into bearish continuation, basically holding this lower low pattern. So unless this happens, the demand zone will stay valid, and don't get surprised if it will respect. So that's it for today's video. I highly suggest you watch more of our content, and if you're interested in our program, you have that up on the description. The main focus is not to win trades because you can do that as well. The focus is not losing the profits back. Also, if you found it difficult, feel free to re-watch until you understand it well.